This weekend, another bank declared Chapter 11, and the world's largest insurer trying to get a Fed lifeline. Things are pretty good considering.
Well, I suppose in terms of the stock market, investors are afraid, Aaron, but I think in addition there's a technical situation, a technical unwind that's associated with Lehman. It's primarily in the credit markets, but it flows through to the stock markets, and that is that credit default swaps and interest rate swaps that were, basically part of Lehman's book are now invalid, and so all investors that dealt with Lehman and had positions with Lehman, and that includes the Street, that includes Goldman Sachs and Merrill Lynch, and includes PIMCO, now are scrambling to reinitiate those positions, and it produces lots of volatility, lots of uncertainty, and technical positions that need to be unwound.
Do you have clarity at PIMCO right now about what your potential losses might be, who the counterparties are? I mean, do you know, or are you still trying to figure it out?
No, we know exactly who our counterparties are. We know exactly how much we have on with Lehman. We came in over the weekend and determined that. Now, however, during the day, it's a process of unwinding those and repositioning those positions. And, in addition to PIMCO, there are billions and billions and tens of billions of positions that have to be reinitiated, and that drives treasury rates, that drives swap rates, that drives credit spreads, and that drives the stock market.
Does this exacerbate the credit crunch? Will it get worse now?
Well, I think it continues to get worse, Mark. I mean, credit markets worldwide are in the process of delevering, which in the absence of new capital leads to asset sales and lower prices and margin calls and further price declines. And last night's policy provisions were sort of private market dominated, including the purchase of Merrill Lynch and, of course, the bankruptcy of Lehman.
Thank you for joining us. We do have Joseph Stiglitz for the next 30 minutes on the line with us. We're going to go to break in just a moment and come back with him. A brief biography of Joseph Stiglitz. Of course, he's a best-selling author. He's also known as one of the chief economist at the World Bank. In 1995, he did a report of the Intergovernmental Panel, and he won the 2007 Nobel Peace Prize. He was also part of a panel with the Nobel Prize in Economics for his analysis of markets with asymmetric information. So he'll be with us for the next 30 minutes. In fact, let's go ahead and just introduce him now. We're about to go to break in one moment. But my sir, a lot has happened since you were last on with us 6 months ago.
Yeah, I'll say. It was a little bit predictable, though, and in fact, I probably, if you asked me, I would have said that I did not think the turmoil was over, and that I think it's going to go on for another year and a half, 2 years, the economic slowdown.
Well, we did ask you that, and you did say 2 to 3 years, going from memory, and that it would deepen. Did you think it would deepen this fast?
You can't predict exactly when these kinds of events happen. Yes, I actually did think it would be happening, I'd say roughly around now. And basically what's been happening is the cumulative effects. House prices have continued to fall. That means more defaults. That means more financial institutions are in deep problems. You can paper things over for a while, but eventually you have to face reality.
Well, stay there, sir. We're going to skip this break for the InfoWars.com and PrisonPlanet.tv viewers with Joseph Stiglitz. For everybody else, we'll be right back. We're speaking with Joseph Stiglitz. He is a Nobel Prize winner. In fact, he's been involved in several Nobel Prizes here, if I read his bio correctly. And when he's been kind enough to come on the show, this is probably, 6th or 7th visit of the last 7 years or so. And we bring you the economists who have been right. We don't bring you the economist who's been wrong, the ones they like to put on TV all the time, though you're on television sometimes, but it's about 90% disinfo, in my opinion. You were getting into the red flags you saw years ago and then going into this war, and why you've been ringing the alarm bells about really serious financial problems. So please continue.
Well, what I was saying is that there are several things, both about the war and the way that it was financed, that should have been a cause of concern. This was the first this was a war of choice. This is a preemptive war. This is a war that, though that as we went to war, we had a huge deficit, and yet the president asked for a tax cut. Usually when you go to war, you ask your young men and women to go risk their lives, and then there's a sense of shared sacrifice. And the only sacrifice the president asked was for people to go down to shopping malls. And there was actually a tax cut for upper-income Americans. Well, the piling up of debt has meant that should a problem occur, and a problem has now occurred, there would be less room for maneuver. We wouldn't be able to do anything. When we had an economic downturn back in 2001, we had a surplus of 2% of GDP, and that gave us a lot of ammunition to use to try to remedy the problem. Now, next year, we're expected to have the largest deficit in America's history. In 1 year, hitting $500 billion. Now, that's one problem. The second problem was that the war is, in my judgment, largely responsible for the increase in the price of oil. It was back in 2003, it was $23, $25 a barrel. Futures markets understood that there was going to be increases in demand from China, from other places, but they believed that there would be a concomitant increase in supply from the Middle East. The war changed that equation, and now we have oil $100 a gallon. Now, normally, if a country is spending so much more money abroad, as we were importing oil from Kuwait, from Saudi Arabia, from other countries, it's going to weaken the economy. But it didn't seem to be happening. And why? Well, some people said there was new laws of economics. Whenever anybody says that to me, I start getting suspicious. What was going on was very simple. The Fed decided to let forth a flood of liquidity, lax regulation. We got a housing bubble. The housing bubble led to a consumption boom. Savings in the United States went down to zero. It sustained the economy for a while, but we were living on borrowed money and borrowed time, and it was just a matter of time before something happened. And so when I looked at what was going on, how the economy continued in spite of the high oil prices, in spite of the war, it was clear to me, and I saw the housing bubble, and I saw what was happening to savings rate. It was, you didn't have to be a genius to say that there were problems around the corner.
In fact, I saw that number in January of 2007, that it was the highest debt ratio for the average American and lack of savings rate, both, since the depths of the Great Depression. In fact, it was worse than late 1933.
That's right. I mean, and that by itself should have been a sign of a problem. But there were even other signs. Housing prices were getting higher and higher as part of this bubble. But most Americans' income were stagnating. In fact, median income adjusted for inflation was declining. And again, you don't have to be a genius to say, look, Americans can't spend more and more if their incomes are going down more and more on housing, if their incomes are going down and down. This was a pyramid. This was this was a house of cards. And the banks, in spite of the fact that the housing prices were getting so out of line, increased the fraction of the value of the house that they were willing to lend against. And they were actually having loans where you didn't even have to pay the interest on the loan.
Just incredible. Now, expanding from there, where do you see this going? I mean, how do you see the government, the Treasury, the private Federal Reserve, this whole international order dealing with this? Because I've seen Financial Times of London articles saying, look, other contractions, other speculation, bubble implosions have been manageable, and have even been some opportunities for people that weren't in debt and people that did save, both at the local level or the international level. It didn't matter where you were geopolitically. Now they're talking about this being a financial black hole that, if it continues, might even make the Treasury become insolvent. I mean,
Well, this is clearly the most serious problem since the Great Depression, and in some ways worse in terms of the financial institutions. The reason, in part, is that while some of the same problems that have occurred then and have occurred since then, excessive leverage, pyramid schemes, bubbles, have happened before, the so-called innovation of Wall Street, the financial innovations, it was supposed to manage risk, it created risk, and created a kind of non-transparency that is so great that no one knows exactly what the magnitude, what the nature of the risk they face.